my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of LME 3-month nickel and zinc. I'll start with LME 3-month nickel. There are two factors here, one longer term on something I've already highlighted, and one much more recent from last week. I'll deal with the one from last week first. We had a weekly key reversal up last week. An interesting move, as the previous week saw a strong dive lower after forming a 3-day bearish evening star pattern at its peak in the first 3 days of that week. A really interesting bearish evening shooting star pattern, type 1 bearish, at its apex. The fall from its height was not held up by the medium moving average, currently at 17,390, but it no doubt eroded it a little. Now, it was further eroded by the big old middle time, currently at 16,880 of the shallow 2017-2018 bullish shift pitchfork, and ultimately halted by the looping higher short medium moving average, currently at 16,850. However, I suspect the market took a look at what the support was below that, lower, and decided that enough was enough. You see, below we have the rising long moving average, currently 16,560, and its partner since March, the lower time of the October 2020 to March 2021 bullish shift pitchfork, currently at 16,500. All that was enough to cause a combined key reversal up and bullish engulfing pattern Monday last week. And the rest, as they say, is history. Indeed, I was quite surprised that the market did not hesitate around the recent 50% Fibonacci line at 17,890, but motored higher to make a fresh high, not seen since March. Now, I've drawn a fresh new, relatively small bullish Andrews pitchfork for the recent action. Small, at least in terms of these other behemoths I've already mentioned. It is for the April to May action, and the market is in between the lower time, currently 17,115, and the middle time, currently 18,150. I have no strong allegiance to this bullish pitchfork, I'm just trying to use it to describe the market. Overhead we have the congestion from August 2014 between 18,400 and 19,070. I am unsure of its strength right now, but it does lead me nicely into the second factor I've mentioned earlier, and one of which I have already mentioned part of. It is the October 2020 to March 2021 bullish shift pitchfork, of which, as I say, I've already mentioned the lower time. Well, this is a larger and longer term bullish pitchfork, which has had the lower time very severely tested throughout March and April. And though pierced, even breached if you will, it has still not been broken. This pitchfork is giving the bullish angle of attack of this market, which is why we must look to the middle time overhead, currently at 18,810, as being the next serious piece of resistance. What is more, it is shallow. It only rises by about $10 to $15 a day. I will just finish off here now with something I spoke about a few weeks ago. A big pattern, and I quote, "The action since mid-February now resembles a pattern known as a big W. This is a variety of the double bottom pattern. Steep sides, well, the steep sides are what make this action give its name. Typically a move back up on the right hand side of the pattern matches the left. The question now is whether the pattern started at the hesitation in early April at 18,650 area, or earlier and higher in the 19,940 area at the September 2014 high." End of quote. Well, it seems the pattern started in early April in the 18,650 area. So if you're looking for a level of resistance nearby on the top side, imperfect as such a pattern would now be, then there you have it. LME 3-month zinc. I wrote back in November last year how the bullish incentive was still alive. This was due to the, and I quote, shallower bullish shift pitchfork for the same move, and that was the early July, early October 2020 move. End of quote. I also added, and I quote again, "So whilst superficially the market may be topping and looking sideways to a potential move lower, the reality is that the bullish incentive is still alive, though at a less acute angle. It all depends on what the market will do with the big old 50% Fibonacci line at 2806, because there's a lot of support below and also resistance above." End of quote. Since then the market first chose to punch lower, then turning back upwards, halting only just before the April 2019 high at 29.58. Since then, prices have dropped, then be held on a closing basis by both the short medium moving average, currently 28.93, and then the medium move and also the medium moving average, currently 28.26, ending up back where it all started in November last year at the 50% Fibonacci line at 28.06. The issue is that time has moved on, and the lower time, currently 29.71, of the original shallower bullish shift pitchfork mentioned earlier, has also risen and been threatened once again. Only this time the market has understood what was going on, and prices moved higher to combat it. That doesn't mean the move up was not without incidents. As recently as last week, the lower time was pierced on Monday. However, you can see from the action of Thursday 2 weeks ago until last Tuesday, even Wednesday and Thursday last week, that the amount of indecisive doji crosses and indecisive spinning top patterns, that the market was very, very uncomfortable riding along this lower time. Hence the move higher on Thursday last week. Now, I've also left the more recent broken October 2020 to February 2021 bullish Andrews pitchfork on the daily chart. The reason why is that despite its broken nature, much more than the earlier, older bullish shift pitchfork, it still provides, I think, a better and more accurate bullish angle of attack. Or rather, the broken lower time, currently at 30.55, does. I've been humming and hawing over where I should retire this pitchfork for weeks now, and yet still I find it useful. Finally, I'll deal with targets X1 and X2. Please cast your mind back 4 weeks ago when I spoke thus, and I quote, "You see, there's the possible, now very probable, diamond pattern formed over January to March. This pattern could see this current move up as a righteous move higher. I was ready to retire this pattern 2 weeks ago, which is actually now 5 weeks ago. I said as much at the time, but I have kept it on, as despite the delay, it may give a target to look to. So, in case of this break higher being genuine, also taking into account the idea that the bullish incentive is still secure, I've placed a couple of possible targets topside. Target X1 in the 30.95 area is the preliminary target for this misshapen diamond as a continuation pattern, whilst target X2 in the 32.15 area is a full move higher from the diamond. Now this last one is coincident with the June 2018 high. It doesn't mean that they will happen, it just means that as we've started the move up, you'll have an idea of the size of move available." End of quote. We've already reached the first target X1, and today it seems the market may be setting up to try for target X2. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.